Welcome to Beyond Wall Street, presented by Arixa Capital, where expert investors make their unique investment strategies easy to understand. I'm your host, Jan Brzeski, and today I'm with Alexander Schoenbaum, CEO of CrowdOut Capital. We'll be discussing direct lending to smaller private companies as an investment strategy. Alexander, it's great to see you today.
Great to see you as well. Thank you for having me.
So I'm excited to dive into what you do, and you're the first person that we're interviewing that makes loans to businesses versus loans that are secured by assets and collateral. So this is going to be very interesting. For starters, tell me about yourself and how you got into the business and the career that you're in today.
Sure. I'm based in Austin, Texas. I grew up here and have been in finance my whole career. I found finance through really my dad's work. He was a corporate finance attorney, and I got to know some of the investment bankers he would work with, and they convinced me that being a lawyer was boring and that I should go do the money side of the deal. And so I ended up majoring in finance as one of my majors, and then joining an investment bank, and then being in a private equity and private credit shop, and eventually starting CrowdOut Capital about 5.5 years ago.
And what is CrowdOut Capital?
We're a direct lender, so a non-bank lender to smaller companies. We typically define that as businesses that are 10 million of revenue or more, not mom and pop businesses and not larger public companies, but sort of that, we call it lower to middle market space.
Terrific. And walk us through a loan or maybe a couple of loans that you've made recently so that we can understand the size of the loan and some of the other parameters of the loans that you make.
We recently did a loan to a nuclear construction business and contractor that builds nuclear facilities, manages and maintains them, as well as other complex construction across the country. There we partnered up with a couple of actually different lenders as well to give the company new money to, one, repay their old loan, and two, to help them grow as they're adding on new lines of business both in the US and Canada. And that will be a $50 million total facility where we provided about a third of the capital along with two other providers. We teamed up and gave a pretty good solution to the company that helped them go through this growth phase where they are transitioning into a much bigger business and they need a little bit more flexibility as they're doing that.
And is it common for you to have a club of lenders and be part of a club of lenders on a particular loan, or is it more common that you are the only lender in the slice of capital that you're providing?
We club about a third of the time or less, so it's not uncommon, but it's not our primary objective. We typically will do that when there's some expertise that we may not have in-house that one of our partners may have. In this particular case, one of our partners specializes in energy related or power related businesses, so it was very helpful to have them as part of the process. Or in other cases where a loan is larger than our typical hold size, and so we want to manage our risk levels from a concentration limit perspective.
Great. And talk to us about the typical maturity of these loans, and also what kinds of costs and interest expense do your borrowers typically pay?
Our loans tend to have terms between 2 and 4 years. I'd say they're mostly 3 years. Interestingly enough, they tend to pay off in 2 years or less anyways. That has been the history both with CrowdOut as well as the industry overall. It tends to be about a 24-month duration. In terms of interest rate, they tend to pay sort of in the 8 to 11% return. It depends a little bit on interest rate environment. You know, a couple of years ago when rates were a bit higher and LIBOR was a bit higher, rates were a little bit higher. They've come down now as the interest rate market has gotten a little bit lower. Sometimes there's other features, sometimes there's amortization, sometimes there's not. We really try to craft a loan that fits well to the business as opposed to trying to craft a business to fit to our loan.
And is there an origination fee as well, or an exit fee typically, and how big would those fees typically be?
Generally there's an origination fee. Sometimes there's an exit fee. That sort of gets back to crafting the loan for the borrower. We might supplement the current maturity or the current yield with an exit fee to make up for the return without necessarily burdening the company with cash flow. On the origination side, it tends to be 1.5% to 3% depending on the size of the loan, typically around 2.
I know that your returns are strong, and remind me how you get there. If you're charging 8 to 11%, are you using structural leverage? Are you to generate returns, or are the investors participating in the origination fees, and that's how they get their returns a little higher?
So we don't use any structural leverage at this time. And so how do we generate higher return? Some of it is prepayment fees. So we noted that our loans typically go maturity-wise 3 years or more, but they pay back in 2 or less. There tends to be an early repayment fee that comes along, and that does help juice returns. Sometimes we pass along origination fees, sometimes not. It depends on the size of it as well. Sometimes we have exit fees or other features in a loan. And our least favorite form of compensation is if a loan has trouble, we might charge an amendment fee or default interest to compensate us for the risk that we're now taking that perhaps we weren't at the beginning of a loan.
So are most of these companies that you're lending to companies that are partly or wholly owned by a private equity firm, or are they family-owned businesses? Is it all across the board? I know that some people in this industry just specialize in lending to private equity-backed companies. How do you look at all of that?
We're relatively ownership agnostic in terms of the form of ownership. So we've lent about a third of our loans have come to actual public companies, so publicly listed businesses. A little less than a third have been to private equity, and the remaining have been to closely held businesses or sort of friends and family type of ownership structures rather than a traditional private equity firm as well. Our focus is really on having a good partner, whether that is a public company management team or board of directors or a family office that owns a business or just a founder himself or herself. We're more focused on the relationship than we are the form of capital.
And you mentioned that most of the loans pay off in about 2 years. What is the most common way that the loans get paid off? Are they selling the business? Are they recapitalizing the business? Are they getting a new loan at a lower rate from a bank? Or what do you see as kind of the top 1 or 2 ways that these loans pay off?
Number one is definitely selling the company or recapitalizing the business in some fashion, whether that's to private equity or to a strategic buyer who's acquiring the company wholesale. That tends to be the primary reason. The secondary reason is a refinancing. Ultimately, we are more expensive than a traditional bank, and so we are excited for our borrowers when they transition from us or really graduate from us to much lower cost of capital, which is a bank. And we try to help them with that. If they want our help, if they don't want our help, obviously we don't help them. But our goal for them is to help them move on.
Very good. What are your top 1 or 2 things that you like about your strategy when presumably you're investing your own money in this strategy? So what do you like about it? And then talk us through the top 1 or 2 risks that could result in a loss of principal.
I love having enormous margin of safety in our business. We really focus on less than 50% loan to value in our portfolio. I love that aspect of it. It's really great to work with lots of different businesses across the whole country, and so we're taking diversified risk, both from a business perspective as well as a geographic perspective. We've got lots of capital underneath us, and because we focus on partnering, we've got great partners running those companies, which makes me sleep better at night. On the risk side of things, you can just take all of that and turn it around and say, if we find ourselves falling out of partnership with our management team or our ownership group, that can cause real strife within the company. Or if the margin of safety evaporates for some reason, it could be, we just went through COVID, so my hospitality borrowers have struggled through it. Most have figured it out. Others are still working through it. Or if there's perhaps an energy shock or a supply chain problem, some factor that is maybe foreseen, but typically it's something that was not foreseen that has caused us issues in our portfolio. I think mostly the foreseen problems we've already identified and have worked through. It's those ones that crop up sort of unexpectedly that have been the hardest.
So where does an investment in something like CrowdOut's loans, where would that fit into somebody's portfolio? do you consider it an equity substitute or a substitute for the fixed income part of their portfolio, or something completely different?
I think it's a great fit for someone's fixed income portfolio, depending on their risk appetite, maybe a little bit on the equity side of things. We are generating closer to equity returns at just over 10%, almost 12% historically, net of fees. Maybe that will continue. The interest rate environment is compressing, but we really look at this as like a safe bet or a safer bet. It's certainly not lending to the U.S. government, but our perspective is this is a nice product to mix in with the traditional, at least right now, lower yielding fixed income products in order to boost that fixed income return overall.
So when you're deciding whether to make a given loan, what are your underwriting criteria? You mentioned that your loans are typically about 50% of the value. So if you think the company is worth $20 million, you could probably lend up to maybe $10 million max. But what else are you looking for? Given all the factors that you've told us before, what matters to you when you're making a loan and what doesn't matter as much?
I think the number one thing is relationship with the company. We're not interested in a transaction for transaction's sake. We want to make sure that we have a partner. And ultimately, we lend to people. So that's number one, first and foremost. Of the 5 C's of credit, which is an old algorithm that bankers used to have, or maybe still have, character is number one. And so we really focus on that character. From there, we're looking at cash flow, another C from the 5 C's of credit, where a business is able to really make its payments. And there's a lot of simplifying here, but the next one is really margin of safety. Yes, it's a loan to value ratio, but it's more than that. Could the value get compressed very quickly under normal market circumstances? We might think about a commodity business, maybe an energy company, where the price of oil goes from 100 to 50, and so that margin of safety collapses in a very short order. That's not something that is very exciting for us. We're really looking more towards a strong, defensible business. We know it's not going to be completely perfect. Candidly, no business is completely perfect. And so we work with the company to try to figure out what that issue might be and make sure that we can pre-solve what might likely be a problem.
So what would be your recommendation to viewers of our interview series who might be interested in investing in loans to companies of the type that you do and other companies in your industry? What would be your recommendation to them? What should they look for when evaluating whether to invest in loans with a particular company like CrowdOut or someone else in your industry?
I think the very first question is, how have those companies performed, or how have those managers performed in difficult situations? Credit market has been extremely generous over the last 8 to 10 years, and so it has covered a lot of sins from a lending perspective. So really understanding how those lenders handle things when they've had trouble within their portfolio is question number one. I think question number two is, do you trust the people that are managing your money? And that comes from a lot of different ways. But have they done it before? Do they ask good questions? And one that I personally like is, are they curious people? Do they read? Do they like to learn? Because what we've seen is, and we've partnered with lenders across the country, those that are more interested in the businesses they work with tend to do a better job of recovering, versus those that are just interested in making a loan tend to struggle.
Alexander, thank you so much for your time, and thanks for explaining your business of direct lending to lower middle market companies.
Thank you, Jan. Have a great afternoon.
I'm Jan Brzeski, and you've been listening to Beyond Wall Street.